Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we are coming to you live from the CNBC-TV18 Motilal Oswal studios, and the roller coaster continues. We'll get into the details in just a bit from now, but I think it's sufficient to point to Surabhi's dress color. Yesterday it was green, today it is red. So, morning, guys.
I had nothing to do with it. It was selected by our very able wardrobe team. But this is all I've been hearing since morning, that it's this wrong color that I've picked for the day. Well, it's like you embrace what's going on. Beyond the point, you just embrace it. So it's fine. Red, green, it's all part of life.
So yesterday you wore green, right?
Yes.
And markets were red.
So ended red. Flat, no? Recovered from the opening gap.
Yeah,
I don't know. Anyway.
But today is going to be an interesting trading session because India has underperformed and now you have the global markets that are in a tizzy. So how much of the bad news is already in the price for India? Well, today is going to be that crucial session, I think.
Well, absolutely. And I think, in the US, the debate still continues because, and that debate was interrupted last Friday when the market bounced very strongly. The debate all of last week and maybe the last fortnight has been that whether the US has entered into a bit of a correction. And it looked like that. Then Friday, the market bounced about 2.5–3%, right? And a lot of people went over the weekend were saying, well, the market's being bought into, the dips are being bought into, etc. So, but last night, look at what's happened. The market fell again, the US equity market, that is, down about 1.7 on the S&P, NASDAQ down about 2.6–2.7%. VIX was back above 22, which is a 16% jump, the CBOE VIX index. 10-year yield lost 5 basis points. I mean, it's remarkable how quickly bond markets have repriced, right? Bond prices have gone up, yields have fallen, and we're at about 4.16%. I think we have lost maybe 50–60 basis points in the last 1 month or so. So it's just incredible. And that's essentially pointing to nothing but fears around tariffs and what that will do to growth in the US. Dollar index about 106.56. Data which came through from the US continues to be sobering. And over the last 10 days, high-frequency data, starting with US services PMI, we mentioned that number with regards to the Atlanta Fed GDP now. That's a GDP projector for the first quarter, which had turned negative. I think it's turned even more south. So, stagflationary concerns on the back of ISM manufacturing data, which came out last night. That's the latest one. And why? Because prices paid sub-index surged. So prices went up. And new orders and employment sub-indices within the ISM manufacturing, that actually fell. And, prices are higher, growth is lower. And hence fears about whether we are entering a bit of a stagflationary zone, not using that word lightly, but it's just sort of, something which kind of was the overlay, at least last night. Now, in terms of tariffs, and they come in thick and fast as well. Today, of course, was the day when tariffs go into effect, Canada, Mexico, China, and looks like they are going into effect. So China's extra 10% tariffs on top of the 10% which is already present is going into effect. And, the executive order was signed. So the order said 10%, it's been replaced. The 10 has been struck off and instead 20 has been put in. So, the 10% extra on China has come through. By the way, the response from China has been, the fact that they've obviously strongly opposed it, but there is no action yet. They're saying, well, let's get into a dialogue. I mean, it's more conciliatory in that sense. Before a dialogue, will China want to do something it's obviously going to be a negotiation. So we'll see. Trump, of course, also confirmed that 25% tariffs on Canada, Mexico are coming on Tuesday as well. There was a specific time which was mentioned, I think our time, 10:30, but it was given earlier that these tariffs will go into effect. So we'll see if last minute something comes around. But I think Canada has already retaliated and imposed tariffs on the US. So again, a very, very fluid kind of situation out there. It's all, of course, taking into effect today, all these tariffs, etc. And remember, China, of course, is the big one. It was widely anticipated. But Canada and Mexico are some of the closest kind of sort of trading partners for the US. and their next door neighbors as well. So the impact actually perhaps could be significantly large if these tariffs are put on for a long period of time. Oil prices about 2.5% lower, we're about 71. And this is not because of Russia, Ukraine. There was an OPEC Plus delegate who announced that the group will increase oil output in and beyond April. There's more oil in the market, perhaps. In India, just to sort of tie in the levels, etc., it's a lower start, and I'll refer to the GIFT Nifty in just a bit. We are still waiting for a positive daily close. Look at the close yesterday, almost there. And of course, from the lows of about 22,004, it was a decent bounce back. This morning is going to be, of course, lower. So a low of 20, which is yesterday's low, which is 22,004, is an important level. We'll sort of work with that first up. Below that, as I said yesterday, between 21,800, 21,900, there were multiple lows which were made and respected in the middle of 2024. So between 21,800 to about 22,000 is the broad support zone. And of course, the upside, the 40-hourly exponential average, which is 22,400, is the resistance. Nifty Bank yesterday tested the previous low of 47,844 and then bounced a little bit. Resistance for the Nifty Bank stands at about 48,675. So we'll see if the levels on both these indices are respected, despite the very, very red screen that we've got globally speaking. So 160 points lower on the GIFT Nifty. Surabhi.
Oh, absolutely. It's this tariff trauma that's getting a little real now, isn't it?
Yeah.
Because, I mean, when Trump took office, there was all supposed to be, a brinksmanship, but now those numbers are becoming a reality. And that's what sparked what is not just a global equity rout, it's a global risk-off across asset classes, whether it's bonds, whether it's the moves in the dollar, or whether you're looking at what's happening, for instance, in cryptocurrencies as well. And I'll come to that in just a bit. First, let's look at the Asian market rout. Now, markets are down anywhere between about 0.3% in Singapore. Singapore is actually relatively the best market in the region right now. To Japan, the hit on Japan is quite big, almost 2% there. The Hang Seng's opened weaker as well, 1.5% on the lower side. Actually, on tariffs, I just want to point out, what the US president also said, and maybe why the Japanese market's taking such note of it. He went on to, slam both China and Japan, and he spoke about how they're using currency as a tool to perhaps enhance their export value. The quote is on your screen. He says, I've called President Xi and leaders of Japan to say you can't continue to reduce and break down your own currency. You can't do it because it's unfair to us. So that's what he's really talking about. He's saying it's difficult for us to make our Caterpillars and our tractors here in the US if you're using currency to your advantage. And, a lot of these headlines coupled with the reality of tariffs, it's really hitting the Asian region today. Okay, let's talk about why this is not just an equity sell-off. Like I said, even, cryptocurrencies, despite that announcement that came in on the strategic crypto reserve that Trump is going to make in the US, despite that, this whole uncertainty is hitting cryptos as well. Markets are down anywhere between 4-5% to almost 9%. The overnight tumble on Bitcoin was 9%. They're again down about 3%, 4% this morning, all the crypto assets. To add to the mix, you've got, of course, the Ukraine issue. And now it's official. This morning, we've got news that White House has decided to stop all possible military aid to Ukraine. So it's very, very clear that this is not sort of ending anytime soon. So that geopolitical risk premium is continuing as well. Talk about some data out of Asia this morning. We've got the unemployment data from Japan. It's all right, slightly weaker than what the market would have liked to see, perhaps. Unemployment rate at 2.5%. The estimate was 2.4%. There's some data out of South Korea as well on retail sales, and that's also slightly weak. The key to watch is going to be the big Chinese meeting that kicks off this week. In fact, today we're talking about the parliamentary gathering, which is in 2 phases. And tomorrow is going to be the really important one because the National People's Congress, will start. And ahead of that, the expectation is that A, they'll lower their inflation estimate for this year to 2% because there's deflation very clearly entrenched in China. And B, the growth number is supposed to be around 5%. That's what the market's working with. But the bigger issue is, will China announce something more significant in the face of the tariff threats that are so real? Now it's 20% tariffs from the US, additional tariffs since President Trump came over. So let's watch for this. Now, for the Nifty, we're all bracing for that gap down, no taking away from that. I was looking at the election day lows, just for what it's worth. So we're 226 points away from the close of that day, June 4 close, 226 points away. That could happen, who knows if it happens today in the gap down. And then the actual intraday low, which was 21,281. That's about 3.5% or 3.75% away from where we are. So let's see. These are sentimental levels. You don't know if the market's indeed done with this bear hug or not. Doesn't look like it. Fund flows, finally, to round it off, Nothing very happy to report here. The selling continues, 4,800 crores of selling. Domestic buying is very, very heartening. Look at that number, 8,800 crores of domestic buying coming in, trying to provide support to the market. Let's see, I guess, Nigel will need more of that domestic money to kind of recover from probably what will be an opening blow.
Well, on a day like today, you thank your stars that, in fact, the Indian markets have actually already underperformed. And the second factor is a high amount of crude into the markets will be good from an India economy point of view as well. So those are the two positives that I'm looking at. Now, India, yes, in the recent 6 months to around a year or so, we have underperformed even the emerging markets. But how does valuation stack up post the recent underperformance? Remember, on a 10-year basis, the Indian markets have done much better in comparison to the emerging market index. But post this correction, how are things stacked up? The India's premium to the MSCI emerging market, well, that's come down to close to around 59%. That compares with around 78%. On a PE basis as well, on a forward earnings basis, we are much lower in comparison to the long-term averages, which is at around 20.5. Currently, we're at around 18.6. And more than 50% of the Nifty constituents, well, they're trading below their long-term averages. So valuation-wise as well, a lot of stocks have come to those levels. Only the market cap to GDP number, well, that was at around 135% or thereabouts. That's cooled down to around 120%. So that's how valuations are stacking up as of now. A lot of factors are suggesting that the Nifty has gotten to that zone where it could see some kind of buying and some kind of bottoming out. And various stocks have come to those attractive levels as well. What did the FIs do in yesterday's trading session? Quite interesting, right? They sold in the cash market. But on index futures, they added more longs than shorts. Even on stock futures, they added more longs than shorts. Now, some part of this could be an arbitrage that's at play, but that's been the trend. They have been net long on stock futures, as you can see, while on the index futures, they're aggressively net short as well. So select stocks could continue to do well. Some part of that will be an arbitrage, but otherwise, in fact, there appears there is some long addition on individual stocks as well. That's another data point, right? SBI Securities, they put out a note and they said that now only around 18% of the Nifty constituents are trading above the 20 simple moving average. And whenever history suggests that whenever that number comes down below 20%, you normally see a bit of buying and a bit of a bounce just in the near term. Price action will have to be monitored, but that's an interesting data point as well. Less than 20% of the Nifty constituents are trading above the 20 simple moving averages. So keep an eye out on that parameter as well. Moving to the options data, well, the 22,400 call, 21,900 put, extremely active in yesterday's trading session. And just looking at the options data and the recent moves that we're seeing, the important range comes up for you in the screen. The 21,800 mark, that's the important mark on the downside. The PCR as well is moving to in that band of around 0.7 to around 0.8 or thereabouts. Crucial levels. 21,800, very, very important that it holds out at these levels. And I expect the bulls to come in and fight at these levels if we get around there. However, the trend is still very, very weak. The structure is punctured. So we'll see resistance coming at around 22,500. You'll only get more confident once you get past that mark. On the Nifty Bank, yesterday we went to around 47,800. Well, that 7,500 is very, very important for the Nifty Bank. Did a relative underperformance. It needs to get back to its fighting ways as we've been seeing in the last few trading sessions. So it'll have to outperform yet again. And finally, before we wind down, I just want to pull up a few stocks. There are some factors at play, which is beyond fundamentals, and that could be trading action. Tax harvesting, there will be advanced tax payments and also margin triggers. And that's why in yesterday's trading session, you saw a few stocks that fell on very, very low volumes and then bounced back. So just highlighting few of these stocks in yesterday's trading session that saw a big bounce of more than 10% from the lows of the day. And there could be more of the same just in the near term. That's because of the year-end phenomena as well as, some margin triggers that are gradually getting out of the system.
Absolutely, Nigel, agree with that. The only point with tax loss harvesting is that you've got the whole month.
Yeah.
People might say that there are more losses. We'll book more losses, then harvest them maybe by the 20th. You never know.
We could expect more of the same, I think, the next few trading sessions.
Yeah. Let's see. But eventually people do want to book those losses as well to offset against other gains. Perhaps maybe that could provide some comfort. Let's move on. Equity call of the morning coming in from Gautam Duggar of Motilal Oswal. He says the market correction has coincided with a slowdown in earnings growth as the Nifty 50 has managed only 4% profit after tax growth in the 9 months so far this fiscal year. That's FY25. He says the expectations for FY26 corporate earnings are still somewhat elevated in their opinion, given the underlying macro and micro backdrop, and are thus ripe for further downgrades. He says the recent correction in the broader market factors in some of the potential disappointments in earnings ahead. That said, he adds that valuations for mid and small caps are still expensive vis-a-vis their history, as well as vis-a-vis the Nifty 50.
All right, Ben Powell is with us, Chief Middle East and Asia Pacific Investment Strategist at BlackRock Investment Institute. Ben, good morning. Good to have you with us here. Thanks for your time. So the tariffs are finally taking effect. Now that they take effect, I think the next question is going to be how long will they be around for? Because these tariffs are essentially with regards to, they're not tariffs, at least that's not what's been stated. They're not tariffs to raise revenue for the US. They are to stop the the flow of drugs, illegal drugs into the US, right? Fentanyl, etc. So it's for a specific purpose. So you think they'll be around a long time, or resolution will be found?
Good morning. Yes, a historic day, actually. I think unusually we can have a clear moment where we move from one paradigm to a different global economic paradigm, and that's today. So the tariffs, as you say, go from theoretical to real, so they are here. To your critical question as to whether they're going to persist, but the honest and real answer is we don't know. And even the specific tariffs you're referencing towards Mexico and Canada, seemingly to do with the fentanyl crisis in the US, there's no clarity on exactly what Canada and Mexico need to do to kind of get tariff relief. Rumors are that President Trump is watching deaths specifically in the US, but that's not confirmed. So it's an extremely uncertain situation. So are the tariffs going to hang around? We don't know, which is the uncomfortable answer. And I think it's that uncertainty which is something that we do know. So we don't know exactly if the tariffs are going to persist in what numbers, but the tariff uncertainty for sure is already weighing on sentiment both in markets and economies. And I think that is that uncertainty is a kind of permanent change, which we're all going to have to kind of get used to as investors in the months and even years ahead.
Absolutely, Ben. Never a dull moment, I think, since President Trump took office, right? But while you're absolutely right, I agree with you, there's no way to know whether these tariffs last, whether they get changed tomorrow, who knows? But if you work with what we have right now, which is, say, 25% Canada and Mexico, and now 10 plus 10, which means 20% effective additional tariffs on China, if we work with that, then are we looking at a very real possibility of a growth slowdown, higher inflation in the US? Because that's something which will be very tangible. And that's, I think, something that's beginning to worry the market.
Yes. So I think, look, this is now a stagflation shock, moving from theoretical to real. Interestingly, the market, I think, for now is very much focused on the growth element, which is not wrong, but I worry it's incomplete. So the growth impacts of a tariff conflict, I mean, Canada have already said they're going to retaliate. President Trump and his team have said they will retaliate to the retaliation. So we are potentially, right at the beginning of this kind of tit-for-tat escalation. So that is going to give everyone the heebie-jeebies. You would expect to see less spending, people kind of reining in, whether you're a company or an individual. People are nervously going to put incremental money away for a rainy day because it very much feels like it's raining. So the negative growth impacts is going to be real, and that's where the market has been focused. So as I say, that's not wrong, it's just incomplete. This should also be inflationary. So if we are imposing just a pure cost onto the construction import of everything, then prices should go up. And I slightly worry that the market is less focused on that, less aware of that, but that should come. So yes, it's kind of a double negative, unfortunately, of a stagflationary shock. For the moment, the market is kind of focused on the stag bit, the slowing growth, which is really important. But the inflationary problem is likely, very likely to play through. And by the way, that might give the Fed much less room for maneuver. There's kind of a hope, or maybe the Fed can save the day, do some cutting and sort of support the growth outlook. That is not obvious to us at the BlackRock Investment Institute, because they, like everyone, are waiting for the inflationary impacts of tariffs, which should be significant. And sadly, another kind of consequence of this tariff new paradigm, which we have entered as of midnight this morning.
Ben, give and take everything. Tariffs, probability of Fed not going ahead and cutting. How do you approach global equities? I recall that you were quite positive on US equities, particularly the AI-focused companies, and the Japanese market as well as something you liked. How are you approaching global equities? You're on give and take everything, all the various factors at play.
Yeah, so we're still constructive. I would say a couple of things. Firstly, clearly, as the facts are evolving in real time, so are our thoughts. So we're still, like everyone, seeing how this plays out and the consequences for global markets. That's the first thing. The second thing, I do think this different paradigm requires more selectivity from investors. So during the good old days, the great moderation, when the kind of economic, geopolitical, even market volatility was quite low, you could be so-called risk on, right? You just were long risk. I think it's a much more complicated situation now, and we as investors need to be much more targeted, much more specific in exactly what geographies we like, exactly what sectors we like, and exactly what themes we like. So I would say this is a time, sadly, we're all going to have to do a lot more work and be a lot more picky in exactly what areas we want in our portfolio and those we don't. You highlighted a couple. Artificial intelligence, we still think is a huge deal. Japan is totally different kind of domestic corporate governance story, but they are examples of the kind of cherry picking approach that we at BlackRock think is just necessary as part of a much more fractured, complicated investment landscape.
No, absolutely. Ben, in the first term, President Trump, by the way, the S&P is still just about under 5% away from all-time highs. So if this is the beginning of a correction, in the first term, he would wake up many times, tweet about how the Dow is looking strong. I mean, so equity markets being high was a big kind of a point of pride, right? I'm assuming that is still the case. Although this time there is another feature. Does he want equities higher, or does he want cost of borrowing lower, which is what is the measure to gauge success? Is it lower yields in the US, which of course is happening, or higher equities?
So firstly, I think the market is working with this assumption. So just to make explicit a very important point that you made almost in passing there, which is the idea that he is constrained to some degree by his sense of greatness. He wants to make America great again. It's not exactly clear what that means, but it probably doesn't mean a recession or the equity market kind of collapsing, right? That doesn't seem consistent with his desire for greatness. So there is a hope and a reasonable argument as to why he is constrained by the equity market, which I guess allows us to somewhat sleep at night. Our concern, though, I guess, is if he really pushes through, if the US administration really pushes through with a tariff-first kind of policy approach, he might get neither. You were saying, is he looking for equities higher or yields lower? Stagflation, if we look, there's a lot of steps here, but if we go all the way through to stagflation, that's bad for growth, that's bad for earnings and bad for equities. It's also bad for inflation, meaning higher, meaning rates higher. So we're not there yet, but I must admit, I'm a bit concerned that if we are looking at a world of more and more tariffs, tit for tat, uncertainty will be higher, growth will be lower, inflation will be higher. And again, that's just bad news prospectively for equities and for fixed income. We feel President Trump and his team around him are, of course, brilliant people. One may or may not agree with their politics, but these are very sophisticated people. So there's a hope and an expectation that they fully understand this. And again, this is more of a hope. We don't know, but there's a hope that there is some kind of constraints imposed by the market and by economic data, with the overarching desire from the US administration for greatness not being consistent, one would have thought, with an equity market kind of maelstrom. So let's see, but that's the hope, I guess, that we're all working with in markets for now.
So Ben, finally, to wrap all this up, where does one hide? It's a very complex world, right? I mean, equities are issues. You discuss some pockets like maybe AI. Obviously, people are piling into US treasuries and bonds because that's a traditional safe haven. But I don't know if that will really sort of work given the stagflation scenario that you described. Basically, for the next couple of months, what's the best hiding ground?
So diversification continues. Sorry to give the normal strategist answer, but we should all be conscious that time in the market is important rather than timing the market. So as best we can, let's try to stay invested, try to stay well diversified, and try to stay more active in our investment kind of approach. So artificial intelligence, we continue to believe in, let's say, the story, and then a few cherries we'd be picking would include Japan, China as well, by the way, and a few others I won't go into here. Just this overarching point. Let's all try to stay focused on what we really believe. It's so difficult at the moment. We're all going to get, or the risk is we all get whipsawed around like tweet by tweet, which is dangerous, I guess. There's a risk there. We're all chasing our tails. So try to stay anchored in what we are really, can I say, high conviction on. That would include artificial intelligence, as you mentioned, but more broadly, a more specific, a more active approach to investing we think is necessary in a more complicated, more fractured geopolitical and economic landscape.
All right, Ben, we'll leave it there. Thank you very much for your time. Great speaking with you, and look forward to our next one. We'll tell you what the corporate interactions are on the show here over the next 2.5 hours. 8:35 coming up. You have the management of City Union Bank to talk about the 2025 outlook. They've announced new business initiatives. 9 o'clock, we'll have Citi's Robert Sockin, a global economist. So tariffs are the talk of the town, and we'll talk more on those aspects. 9:20, Nilesh Shah of Kotak Mahindra Asset Management Companies, a market master of the day. 9:30, you'll hear from the management of Bajaj Auto as they talk about their February auto sales numbers. 9:40, we'll have Jupiter Group joining us to talk about the business and the order book picture. At 9:50, we'll have Sandeep Agarwal of Suvilo Investment Managers talk about trends in the IT space and stocks you need to look at in the IT services pack. And towards the end of this show, it's the economy, Lata in conversation with Jairam Sridharan of Piramal Enterprises on the state of NBFCs. Right, time for a quick commercial break here. Up next, list of stocks to watch out for with our research team coming right up.
Okay, so we're preparing for what's going to be a rocky start. The hope is that it gets better after that gap down. Let's talk about a couple of stocks that you should also keep your eye on. We have Vamakshi joining in to round up the action for us. Vamakshi, good morning.
Good morning, Surbhi. Let me first start off with IEX. The electricity traded volume saw an uptick of almost 9% on a year-on-year basis. The day-ahead market, which is the DAM, the volume shot up by almost 14%. The real-time electricity market saw a much higher growth in terms of volume, up nearly 23%. But it is the market clearing price in the day-ahead market, which was down nearly 11%. Keep an eye out on ASK Automotive as well, because the company has signed a technical assistance and licensing agreement with Kyushu Yanagawa Seki Corporation. This will enable the company to manufacture high-pressure die-casted alloy wheels for two-wheelers. The company, in turn, for that sort of tech exchange, will be paying one-time initial royalty and running royalty as per the agreement, the details of which has not been disclosed yet. RBL Bank is another counter that we will be watching out for, and that is because GST authorities have initiated search at nearly 3 offices of the bank in Maharashtra. The bank said that the proceedings are ongoing and they are cooperating in providing full data as per request placed. In addition to that, they've also announced a couple of appointments. They've appointed T.S. Pari as the Chief Operations Officer. They've also gone ahead and appointed Narendra Agarwal as the President and Head of Branch Banking and Retail Liabilities Business. Apart from that, keep an eye out on Inox Wind as well as Inox Green. CRISIL has revised its outlook on the long-term bank facility to positive from stable and reaffirmed the CRISIL A rating for both of these companies. Now, keep in mind that Inox Green is, handling the operations and maintenance projects of the parent Inox Wind. And overall, CRISIL said that the improvement in the outlook on both of these companies is because of the improvement in the business risk profile of the parent, that is Inox Wind. Lastly, keep an eye out on Time Technoplast. They've introduced a new product that is polyethylene pipes for gas distribution. This is in line with the company's goal to achieve nearly 30% growth in the PE pipe category, and the benefits of this new introduction is likely to flow through from Q2 of FY26.
Okay, Vamakshi, thanks a lot for giving us all the top stocks that we need to track. For the time being, let's turn our attention to the commodities and currency space. Manisha Gupta joins us to update us on what's going on there. Morning, Manisha.
Morning, Nigel. Well, it is slip and slide and fall and decline everywhere that you can see. So it's really a lot of unease in the broader markets there. I'll start with the crude oil prices because we've seen 2% of decline in the overnight markets, and with that, we are trading at a 12-week lows. Also, what's bothering the crude prices is the statement from OPEC that they will increase output from the month of April. Well, this is going on to the lines of what U.S. has been asking OPEC to do, to increase production to ensure that the prices stay lower. We also have seen the base metal prices trade choppy because of the tariffs now taking effect there. So when you look at the copper prices, we've continued to decline, multi-week lows onto that one. Iron ore prices are trading at a 6-week lows as well, and a sharp decline is what we are working with in sense of steel prices also. Markets also are reacting to the fact that we could be looking at higher tariffs leading to inventory buildup in U.S., but shortage in the rest of the world. I mean, that is a phenomena that the street perhaps would want to read more on.
Okay, all right, Manisha, absolutely. I loved how you described it, right? Slip and slide and declines all around pretty much. That's exactly what's going on. Commodities, equities, crypto, everything in a tizzy. Thank you so much for that update. Well, with that, we'll take a very quick break, come back on the other side, and we'll discuss some of the fundamentals and how you can approach a market like this today. Amnish Agarwal of Prabhudas Lilladher will join in.
Welcome back. You're tuned into Bazaar Morning Call. Well, let's get some fundamental analysis going. We have Amnish Agarwal, the Director Institutional Research at Prabhudas Lilladher, who joins us on the show. Hi, Amnish. Thanks a lot for joining in. Amnish, how are you all feeling about the markets? You know, you all have been doing a lot of calls with your clients. What's the mood like? And, you know, what are the top buy ideas you'll have? Because when the markets pull back, you get a lot of stocks at far more palatable valuations. So if you could give us a couple of names.
Okay, see, the markets have been actually going down. It is more like a regular thing that you can say, look at the market, every day it goes down 50 points, 100 points. And the fall, particularly on a Friday, was very steep. Now, if you look at fundamentally, I think the things are improving. The economy is actually coming back to life. 3Q GDP numbers were good. And there are hopes of revival definitely over there. Now, the only trouble which seems to be there is that when people buy and next day or in the few days you see the stock down 5%, 7%, then it puts people off to some extent. But having said that, I think it is more now like a market which is driven by the news flows and technicals. Because fundamentally, I think things are more or less, I think a lot of it is already been discounted. Now, in terms of, say, a few stocks, I think if you look broadly, if we look at, say, our recommendations of stocks, I think today you will find that many of these stocks, they will show you very good, you can say, upside because the stock prices have corrected. Now, specifically coming to themes, I think there are two key things which are very visible now. First of all, the government capex has picked up. So the entire capex, defense, I think all that story, after a gap, I think that will start playing around. One of the key stocks there is Bharat Electronics, which is a play on all the armed forces. The order book is good. The stock today, I think it is available at sub 30 times valuations on FY27. I think this is one stock which looks reasonably good to us. Now, if you look at, say, the other pie, for example, in the, say, your capex, you can have more stocks. For example, even ABB, Siemens, they have corrected. Praj has corrected. So there are a number of names which you can find which look good at the current prices in particular. So now, if you look at the
So BEL, ABB, Siemens, Praj, that those could be part of your top list.
Yeah, but having said that, one should be ready that the growth rate, say for the next couple of quarters at least, it will be lower than what the growth rates people have now used to over the last couple of years. Because the ordering momentum in between was lower and now the base is not that low for all the companies. So the growth rates now will be more secular. Maybe one can expect anywhere between, say, 15%, 17% on a CAGR basis. But having said that, a lot of froth in the valuation has also come off. Now, if you look at the other pie, which is very important for the Indian markets, that is the domestic consumption. And domestic consumption, I think we are close to the bottom and we will slowly start, you can say, witnessing the recovery. And if you can recall, particularly last year, 1Q and 2Q were not great because the elections were there, too much of heat was there. So my sense is that the numbers would have bottomed out and we will see, you can say, slow recovery. But having said that, the way the Indian economy is poised, we might see the recovery coming more on the discretionary side than on the staples. So if you have to pick, say, stocks over there, then on the auto side, Mahindra and Maruti, these are the two stocks which look good, particularly M&M after the sharp cut which it has seen in the last 10-15 days at around 25,000-26,000. I think M&M looks very, I think it looks really, really good at the current prices. Similarly, if you look at what is happening, for example, the airlines are doing very well. We have seen very strong, you can say, your air travel around Kumbh and all. So I think the entire travel space will do well. And it is more like a multi-year story. And the biggest stock to play there, one can play it through two ways. One is your interglobe aviation, which is Indigo, and one can look at hotels. The third could be, you can say, the other segments in discretionary in which some, you can say, the stocks which cater to air conditioners will come because we are likely to have very intense summer this year. Last year, they had very strong growth, but if the summer, as per the initial indications, it is good, then AC stocks can have, you can say, good run for another year or so. So in addition to it, I think on the staple side, you can look at, say, maybe a Britannia, because at 4,500, the risk reward is highly favorable. ITC sub 400, it looks really interesting. Broadly on the discretionary side, even QSRs, even you can say some of the jewelry, they should do well. But the valuations there are not as attractive as it might seem to be for a stock like, say, a Britannia or an ITC. But yes, some of these segments, they are all, I would say, they are all near the bottom as of now. So it would be, I think, a phase of very selective stock picking in my view.
Okay, some interesting ideas there. So perhaps some from consumer discretionary, some from staples, and a couple of names from the capex space as well. Amnish, I want to draw your attention towards cement stocks because the numbers have been looking good. I mean, even in the core sector data, cement production was actually the best of the lot. And it seems the price hikes have been holding so far in the fourth quarter. There's a note from Nomura this morning. They're saying, I think the average Q4 price hike is about 6 rupees. 3 rupees have happened, pan-India price hikes in March itself. So does cement look interesting to you? And if yes, then which stock would you go for?
You see, cement stocks have actually, they have also, along with the market, they have got battered in the past few months. And the 3Q numbers were also not great for all these companies. Now, if you look at, let's say, Ultratech around 10,000 or Ambuja sub 500, I think the stocks per se, they look good. But cement sector, I think there's a lot of, you can say, hopes built around that once they all start using more renewable energy, their cost will go down and the margins will go up. But if you look at cement sector over the years, we have not seen any meaningful increase happening in their EBITDA per ton. Because a lot of these efficiency gains which the industry actually gets, they get passed on to either the consumer or, for example, the government buying or the, you can say, buying on the institutional side that has been quite big over the years. So if one has to pick your cement stocks, I think Ultratech still looks to be the best, followed by Ambuja Cement.
Okay. All right. Amnish, just stay on. We'll quickly get into a corporate conversation and then come back to you for some more stocks. The next management and company on our radar are actually City Union Bank. The stock has seen a fair bit of correction along with, of course, the rest of the financial space in the mid-cap market. It's down about 15% so far in this year. Let's pull up maybe a one-year chart or a year-to-date chart that will reflect that decline that we're talking about. So 12 months, obviously, it's still up 8%, but year-to-date, that decline became extremely steep. Now, one of the new initiatives that City Union Bank has announced is a partnership for co-branded credit cards with Chennai Super Kings. To discuss that and, of course, other business trends, we have Mr. N. Kamakodi, Managing Director of City Union Bank. So thanks so much for joining in. This is interesting. So, a lot of the CSK fans, of course, will be looking out for this one. But just explain the strategy, the rationale. I mean, what are you expecting from your credit card business? Because in the past, I think your stated, move has been that you will grow the retail book more on the secured side. So what are you planning now on unsecured with this tie-up on credit cards?
Yeah, actually, the same strategy of, going with the secured retail continues to a greater extent. At the same time, we could, when we analyzed the data, our own customers have taken, part of a lot of, credit cards and other retail consumption from other institutions where we are losing them from our side, and also it is very much required for our strengthening our retail liability base. So one product that was missing was basically the credit card, with extra focus with our existing customers, being Citizen Bank, being having almost more than 2/3 of the business from, South India, particularly Tamil Nadu. We felt that it is very important for us to fill up the missing product offerings in our boutique. One of the products which we identified was, the credit card, and we found that we have a significant number of our existing liability customers, particularly, are taking a lot of credit cards from the other banks, and ultimately the propensity for losing them appear to be higher. So to bridge that gap, we have entered into a tie-up with, the Chennai Super Kings, which is ultimately the product which is having significant appeal to the cricket lovers of the state. And also, we have very strong tie-ups with a lot of educational institutions in the state of Tamil Nadu, where the next generation students are also having a lot of interest in and association with the brand CSK. When that opportunity came, we felt that it's something which we have to enter into and have a strong tie-up, and that's why we have signed up with CSK,
So, Mr. Kamakodi, if I could just come in, get your point, but if we can get some numbers and projections, that will also help. In the third quarter, of course, your growth picked up. I mean, you've been growing the book at about 15%. Now, as we look at FY26, what would your outlook be for overall growth of the book? On the credit side, within that, how much would be sort of powered through retail? And if you could give the breakup of the retail book right now, how much is secured and how much is unsecured?
Basically, if you look into overall, we had a very, sustained and, decent credit growth in the past, and the calendar year 23 was sort of not a good year for us. When in December 2022, we had about 14 to 15% growth, which is slowly slipped to about 1 to 2% for December 2023. Once again, the growth picked up in the calendar year in 24, and we slowly and steadily increased it to about 15% for that. The current year also, we expect the growth to be between around the same number, plus or minus 1% or so. For the financial year 25-26 also, we hope we should be having 15-16%, 15 plus or minus 1% growth rate. In that, as we had multiple times given, the retail growth, in that 15% growth rate, the contribution from the retail may be between, 1 to 2%. Even in that, we expect the entire credit card portfolio will not be more than 1% of our portfolio in the overall portfolio in the for when year ending 31st March 2026. In that also, not less than 80% will be for our existing customer base, and our existing strategy of focusing more on the secured retail, and particularly in the unsecured, it is only to support our existing customers, not to lose the existing customers, particularly on the liability base. So we want our liability customers, whenever they need the, the credit card product, we don't want them to get into the other brand, other institutions and lose them. So the incremental portion will be minuscule. That's how we have become the credit card partner with the CSK to take care of that one.
Okay, so that makes it clear that you're looking to grow 15 to 16% next year, and the growth on the retail side will continue to be largely through the secured book. Unsecured primarily to ensure that your customers don't go elsewhere if they need a credit card. So that's what the sense is. Just a sense on. We've recently got more announcements from the RBI, right? Whether it is the liquidity measures. Then they've, of course, rolled back some of the prudential norms for NBFCs, etc. So for all the RBI measures that have happened, including the rate cut and the liquidity boost, the FX swaps, all of that, how has that improved liquidity conditions for you, and what do you see in the market?
See, what we feel, as we have seen multiple cycles of interest rate hikes, interest rate lows, and also the tight liquidity condition and lower liquidity conditions. You had a period when it is repeatedly said that the retail depositors are moving more into the, equity, and that's how the incremental deposit growth has started coming down, which is also part of the liquidity tightening. And also you had the government expenditures, that budget was not coming to the retail, commercial banking, but that was with the treasury and all. So all these things are, slowly getting on the unwinding. And we feel when we enter into the decreasing interest rate scenario, going forward in the next couple of quarters, the things will definitely improve. At the same time, whenever you see that there will be some adjustments in the yield what you charge because of the interest rate passing and all, overall things are getting better and better for the, we expect things will get better and better for the banking industry, both on the liquidity front and also on the growth front.
Okay, all right. So thank you very much for joining us. Good speaking with you and getting that perspective across. Guys, while we talk about what are the good levels to buy and whether the market is bottomed, etc., and the debate will continue, for some time to come, I think. Ramdev Agarwal yesterday made a good point. One of the indicators you can see is when promoters start to buy their own shares, because they clearly know more than every other constituency in the market. And that should be a signal, not obviously a definitive kind of a vote that, well, this is the price to buy. And sometimes what happens is they also buy, you see these trades at 5,000 shares, 10,000 shares. It doesn't amount to very much. So, but if sizable buying at lower levels, when it starts to come in, I mean, that could be a bit of a signal. Actually, let's play out that soundbite. Ramdev Agarwal of Motilal Oswal Financial Services on whether that will start to happen and how should you use that as a bit of a signal, as an aid. Listen it.
In 2-3 months' time, when promoters will actually come to buy, because they are the guys who are the smartest. They know the value of the company. So when the promoter starts buying, so actually you can't see that selectively in the companies, promoters will start buying. And those are companies to track. It's a much bigger game. So, the irrationality which was there, where because of lack of supply, the irrationality in terms of pushing the stock price of multiples to 70, 80, 100, irrespective, that was wrong. So that will correct. Even that is behind, I'm telling you. It will correct. What has to be corrected will get corrected.
Okay, all right. That was Mr. Ramdev Agarwal.
Just
Nigel?
two stocks. We had done a small piece on, on CNBC-TV18 with regard to few stocks, JSPL, Maharashtra Seamless, part of the Wellspun Group. Small buying. I think JSPL, the Q3 numbers were very, very disappointing. The stock had fallen, I think, 15%. The promoter came in then the next few sessions and bought close to around 1%. And from there, we've seen some kind of stability. Maharashtra Seamless as well, close to around 0.5% is what they bought. So just a couple of instances from my sector that I recall, where promoters have bought either 0.5% to around 1%.
That is sizable. But I think that's sizable. Because I know so many cases where advisors say, thoda sa le lo.
Yeah.
To show confidence or whatever. But that doesn't mean very much. It's just sort of, or you ask some personnel to buy, that shows up and suddenly people say, well, promoters are buying. But it's not very much. But 0.5%, 1%, that is, so, you got to use that data point intelligently as well and not sort of look at everything as a bit of a signal. Some of it, of course, will be a noise as well. Let's take a quick commercial break here. Sudarshan Sukhani and Mitesh Thakur will be with us with some technical trades on the other side. Stay tuned. Okay, welcome back. You're with us here on Bazaar. 7 minutes to go for the pre-open session. Sudarshan and Mitesh are with us. Gentlemen, good morning. Good to have both of you here. 160 lower on the GIFT Nifty. Will we find some sort of support, or will the market respect 22,000 in some way? or I mean broadly the range of 21,800 to about 22,000? Is that where the market will find some stability? Mitesh, you go first.
Morning, Prashant. So I think, the only thing which is happening is that we keep getting oversold. The put call ratio is now around 0.8, 0.75 zones, which is 0.65 is the standard oversold levels. But as I said, I think that spark of reversal is missing. And that's why, we haven't been trading the index. So in fact, we have some put option spreads on the Bank Nifty. And the Bank Nifty hasn't broken that January low of 48,041 on closing basis. That could happen today. So I think the Bank Nifty could also see some declines, let's say to about levels of 47,600 as the minimum target, but a more logical target is around 47,200 to about 47,000. And that in turn would suggest that the Nifty would also be under pressure in case the Bank Nifty breakdown comes into play. So my sense is that the market pain is not yet over until we see a strong reversal, either with a gap up, which sustains and holds, or a strong bar which kind of engulfs the previous bars. I think we need to wait it out to take some kind of long position on the index. So as of now, my idea remains the same. Either it's a sell on rallies kind of a market, or you trade with put option spreads.
Okay, all right. Amitesh got that point. Let's ask Sudarshan as well. Sudarshan, morning. So we're all bracing for impact, looking at this gap down. What would you do today? Anything at all on the index, or is this let's sit out kind of a day?
Yeah, good morning. It's been a let's sit out kind of a week or maybe 2 weeks. And that's been a sensible idea, at least for me. But it does appear that this market is now getting tired of selling. We could see a gap down today. We could see significant selling. Whenever this gets exhausted, that will be the first sign that for the short term, this selling is over. And I think we are very close to that point. I can't say whether that will happen today or tomorrow, but we are very close. So traders and investors are well advised to watch for signs of a bounce, intraday bounce, interday bounce. That should happen soon enough. So this is not a buying suggestion. It's a suggestion that we are probably coming to the end of this leg of the downtrend.
Okay, that sounds good. That we could be, ending at least this leg of the downtrend, and that would be some relief that maybe the final shakeout happens today and then at least some stability. So let's see if that's the case, then stocks. Sudarshan, what would you do today?
Well, if that's the case, then I have a long buy list. Remember, they are mid caps and you have to be a positional trader, not an intraday trader for them, because the markets haven't bottomed out. Voltas is a buy with a stop at 1341. HDFC Bank is a buy with a stop at 1668. And SRF is a buy with a stop on at 2770. Don't rush to buy them. Wait patiently. If you get a sense that this market has stopped falling, these are good ideas. And finally, Ashok Leyland is an intraday short with a stop above 212. I would suggest that maybe this week we'll probably see some kind of a short-term low.
Mitesh, what about you? What are your trades?
I have all sell list, Adani Ports is a sell for me with a stop at 1,065 for targets of 1,020. HCL Tech is a sell with a stop at 1,591 for targets of 1,535. IGL is a sell with a stop at 186 for targets of 173. And Indian Bank is sell with a stop at 510 for targets of 480. Now, with the gap down, you need to be tactically aware as to when to initiate the sell call, because then if there's a big gap on these stocks, then you might not get a good risk reward entry point. So I think I'll be slightly flexible there. But yeah, the idea is that the market does look, we might remain in some kind of a negative mood.
All right. Thank you very much, Mitesh. Thank you very much, Sudarshan. We'll talk again soon. We'll take a quick commercial break here. We'll come back with a pre-open session. We'll have Citi's global economist, Robert Sockin, join in to tell us what these tariffs will mean and what damage it will do to the US economy. Data has been slowing down. Markets have been starting to turn a little lower as well last fortnight or so. Stay tuned.
Welcome back. So in the next couple of minutes, we'll start getting the idea of how much of this gap down we will be looking at. Asia, as we've been pointing out, is down anywhere between 0.5% to as much as 2% in some of the markets like Japan. So as those pre-open rates start to come through, look at that. First rate on the Nifty is actually 100 points up, if only it works that way. Yeah, sensex 400 points higher. We all know this is the first rate. Let's wait for it to settle, if only. But anyway, let's get more perspective on this whole tariff business that's become a complete reality now. Robert Sukin, global economist at Citi, is joining in with some thoughts. Robert, great to have you this morning. Never a dull moment, right? And now it's real, 25% Canada, 25% Mexico, and 20% effective additional tariffs on China as well. The market is nervous. Do you have some models or estimates so that one can work with that if these tariff levels persist, if they're not rolled back, then what does it mean for inflation or growth in the U.S.?
Yeah, absolutely. It's a very uncertain time, especially with these tariffs looking like they're going to go into effect. But then there's a broader question: if they do, will they stay in effect, and for how long? The models that we've run have shown that of these tariffs, the economic damage is probably largest for Canada and Mexico, given the significant ties to the U.S. economy. But the U.S. is not immune from the negative effects of these tariffs. And you're looking at a world where if our trading partners retaliate, which seems very likely, we just saw some news saying that Canada has prepared a list of retaliatory measures, that the stagflationary effects on the U.S. are kind of amplified, and you get a large negative hit probably over a several quarter period, over 1% off of U.S. real GDP, and you get a sizable boost in inflation. So it is that stagflationary effects that most people in the markets are worried about. So we'll see if they go on and if they stay on, but I think it's a difficult and dangerous balancing act because the negative economic effects might be larger for some of our trading partners, but they're certainly negative for the U.S. As well.
Sorry, Robert, I missed the number. Could you just repeat the rough estimation right now for both inflation and GDP?
If our trading partners put on a sizable amount of retaliation, not one for one, but if they put on retaliatory measures, you're looking at U.S. real GDP that falls over a several quarter period by over 1 percentage point. And I would expect the spikes in U.S. inflation in the short term to be 0.5 percentage point or higher. So you're talking about sizable negative stagflationary effects.
Yeah, absolutely. Robert, hi, good morning. I have two questions. How long these tariffs will be in effect, according to you? Your best guess, base case, as they call it. And second, are U.S. stock markets not as important to Trump as they were during his first term? Because, I mean, how much damage will he tolerate?
Yeah, and these are the key questions. And I think I'd start with your second question, because the framework I've had in my mind and we've thought of on our team at Citi is that we know from Trump's first term that he cares a lot about the performance of the economy and the performance of the stock market. And it seems that under fairly large tariff scenarios, the economy is challenged and the stock market is challenged. You know, our teams at Citi have done a lot of work on this front. So I think on that point, I would assume that the tolerance is fairly low, which brings us back to, I think, even if these tariffs go into effect, my assumption would be that they would not stay on for a durable period because of those negative economic effects that I mentioned and the negative effects to equity markets you're likely to see. So, you know, my base case is still that these tariffs are being used as negotiating tactics to have countries work with Trump on other priorities. But there's a lot of uncertainty. Certainly, I did not expect the tariffs on Mexico or Canada to go into effect at all. If you had asked me a few weeks ago, now it looks likely they may go on for at least some time. So I think it's a very uncertain environment. But I'd be surprised if they'd stay on for a durable period. I think they are the prelude to a larger set of negotiations.
So some pullback of these tariffs actually will be good news, you know, because it's not going to hurt just the U.S. economy. The globe as well becomes a very, very uncertain place. Hi, Robert. Welcome to the show. Thanks a lot for joining in. Well, you know, over the last few months, we have agreed that India is on a firm footing. Growth is pretty okay out here. our stock markets have pulled back a little bit, and we have relatively underperformed. But growth in the past quarter was better than the previous quarter. And from here on, growth should be okay. In addition to that, we have an RBI that's cut, made one rate cut. And the optimism is there in the next couple of months, we get another one. How do you see the Indian markets as well as the economy shape up from here on? And are you as bullish on the prospects here in India?
Yeah, great set of questions. And I think, we've highlighted many times on this program how India has been one of the best performing economies in emerging markets, but more broadly than that, in our forecast, we've been significantly surprised or impressed by the strength of the economy. And for this year, looking for a lot more of the same. So our forecast for Indian growth is roughly in line with last year's pace, which was very solid in the mid 6% range. We're looking for something similar. And as you also noted, some additional scope for further rate cuts from the RBI. So I think the economic backdrop is very favorable. But I would also highlight that these issues that we're talking about of tariffs and trade uncertainty could also come back to India. And, we've seen Trump discuss the potential for reciprocal tariffs with trading partners. And India at times has come into the president's sights in terms of countries to target. So I think broadly speaking, there's a very positive economic backdrop for India, but we also have to be paying attention to more broadly this risk and uncertainty around global trade and ultimately what the U.S. tariff policy is going to look like globally, but also vis-a-vis India.
Okay. By the way, just taking a moment to recap the pre-opening rates, which are now on our screens, 125 points lower on the Nifty, which means it's a 0.5% decline, which is not that bad. And I think it's the scenario that Nigel was talking about that's playing out because we've already fallen so much.
15%.
India has been leading the global equity world in the downward draft, the biggest underperforming market perhaps in the region this year. So therefore, we're not hit particularly hard this morning. And remember that our Commerce Minister is in the US this week to negotiate a trade deal with the US. And if, fingers crossed, if everything goes well, then perhaps, India could see some kind of gains as other partners also, hold their parlays with the US. So we're in very, very interesting times. So not too bad, must say, for a morning like today. Midcap index, though, is down a lot more. It's down about 1% or so. So, Robert, what's the sense? What's the advice? As this plays out from the Fed's perspective, what do you think the next steps could be? Because we had a guest earlier from BlackRock who was saying that all this complicates the situation for the Fed, and maybe the Fed has less maneuvering room if you're looking at a stagflation kind of a situation in the U.S.
Yeah, absolutely. And I think that is the real challenge of the environment we're in now. That if you go back even a few weeks ago, the fundamentals, broadly speaking, the U.S. globally, all look solid going into this year. I think they're still on a solid footing. But what we're seeing now is that a lot of the noise coming out of the Trump administration, in particular with regard to tariffs, is creating a lot of economic uncertainty. And you're starting to see that move into a lot of the economic data. You're seeing, for example, in the U.S., confidence measures come down. You're seeing inflation expectation measures generally creep up. And you're seeing a lot of noise in some of the survey data, some of the spending data. And it's getting hard to assess where the ultimate trend is. And especially if we get these tariffs that come on in force and they stay on, those stagflationary forces that we talked about earlier would come even more into play. So I think we have to pay close attention to the policy developments, be nimble, and watch kind of the negotiations that will take place if those come on. Now, for the Fed, I think it is a challenging environment. I think if you go back again a few weeks ago, Fed was in no rush to remove accommodation, U.S. economy on solid footing, inflation gradually moving down, but with that risk of Trump tariffs looming large and the potential for the stagflationary effects of that. So if those come into play, they have a difficult balancing act to face. And I think it's going to depend on what they're seeing in the data and the size of the tariffs and what they think the effects are. But ultimately, I would think if we got broad-based tariffs and you had a big negative growth shock, I would expect the Fed to be cutting in that environment. But it's a lot to be seen.
Sure. There are too many moving parts. Very hard to sort of model any of this. So kudos to you. Just a final question from my side. China. Now their big, much-awaited March parliamentary meeting is kicking off today. What are your expectations and what is your assessment of the economy? Everything that they've done throughout 2024, is it adding to anything realistically on ground? And would you expect a bigger stimulus to also ward off tariffs plus their own local slowdown issues?
Yeah, absolutely. And China faces an array of challenges on top of the U.S.-China tensions and the tariff risks and the tariffs that have gone on, other sort of internal deep structural issues, unwinding property sector, aging demographics, high youth unemployment, and those structural factors and headwinds are likely weighing on consumer confidence and spending today. And so you've seen relatively tepid performance from the consumer. Our base case going into this year has been that growth in China would slow from 5% last year to 4.2%. That has an assumption of 10 to 15 point increase in tariffs from the U.S. administration, those staying on, so the durable increase. So far, we've seen 10, could go up to 20, right. And maybe more could come after that. So that could create headwinds. But the authorities in China could also come out with more stimulus to help offset that. So I think we have to watch both the U.S. space closely for the tariffs and how the Chinese authorities respond. Right now, we're sticking with that fairly decent growth forecast of somewhere in the low 4% range. But it'll depend on, I think, on those two factors. How the Chinese government responds, particularly for the consumer, to help offset some of those issues I mentioned and the tariff risk, and how large tariffs end up actually being on China and whether those stick.
All right, Robert, we'll leave it there. Very interesting conversation. Thank you for joining us. I'm assuming it's a late hour for you. So good night to you. And as we start our morning, thank you indeed for your time. Sudarshan is with us with 9-10 calls and what he'd like you to do. Sudarshan, tell us.
Well, yeah, consider buying Voltas with a stop under 1341. You have to adjust the stop because of the gap down. It would be a buying opportunity.
Hitesh, what about you?
I'll go with the sell on HCL Tech for targets of 1535 to begin with.
Okay, HCL Tech. All right. Well, I think we have the market open coming up in about 3 minutes or so. If you can just look at the pre-open session and how that has ended. We are down 150 points, so in line with what the GIFT Nifty, largely in line with what I think we had a 160-point cut in the GIFT Nifty, and we've got about a 145-point cut right now, 21,974, so just under the 22,000 mark. And the sort of broad levels from here, multiple lows between 21,800 to 21,900 last year, 2024, middle of 2024. So that kind of becomes the next logical zone to look for the market to stabilize a little bit if it were to. Najal, you want to make a point?
No, I just want to focus on a couple of brokerages that have come out as well.
Yeah.
SBI could be one such stock because Abhishek has just sent us a note that Citi has written. They have double upgraded SBI. Remember, it's been a bit of an underperformer, but they've double upgraded the stock from a sell to buy. The target price is at around 830 rupees or thereabouts, some 720 rupees. And they have made a few points out there. They're factoring in 13 to 14% growth, curtailed credit cost. They also say that valuation-wise, it's inexpensive at around less than 1 time. So it's at around 0.85 times a book, which they believe is fairly attractive. So that could be one of the stocks. A lot of brokerages have written, but this is one of the notable ones because it's a double upgrade. So just thought we'll highlight that.
All right, no, absolutely. 2 minutes out to open. Let's just look at a few other stocks, right? I mean, this is from yesterday. REC and PFC. So these were two names which saw some buying yesterday, about 4%, 4.5% each. By close. So they're starting about 1.5% lower, REC and PFC. Let's look at the hospital companies. Narayana was the biggest volume-led gainer, surged 10% yesterday, but there was also Medanta. So Narayana and Medanta, if we want to take a look at it, so giving back about half of yesterday's gains, and the other one is Medanta. We spoke about the AC companies, Blue Star and Voltas. I mean, if you're talking about cooling themes, maybe throw in the Varun Beverage name as well. I think there's a brokerage upgrade in Varun Beverage as well. CLSA. So Voltas, Blue Star. These are all sort of big gainers yesterday. There was Supreme Industries, which surged about 6.5% in trade yesterday on volumes. And there was something like a Religare, which came up about 5-6% as well. So these are essentially broader outperformance that we saw. I just want to make one point. Maybe today will be different. But I said this yesterday as well. Yesterday, after a very long time, you essentially had the number of stocks which actually went down lacking volumes. You didn't have a very long list of names with a lot of volumes. Volumes were all on stocks which actually went up. So that's a, I think, important point. Maybe points to some amount of selling exhaustion, at least in the near term. 0.5% on the Nifty, so 22,000, around 22,000 right now. Around yesterday's lows, basically. You got the Nifty Bank, which is down about 0.25%, 47,990. The IT index is down about 1.3%. So the weaker US data does not help for a globally exposed sector like IT services, and we've seen that last week as well as data soured in the US. The IT index sold off about 7-8%, and this morning it's starting lower. And 3 names in the green and everything else up, everything else down is what you have at this point in time. So becoming a little deeper now, but about 0.5, 0.6% in that range as far as the Nifty index is concerned. Too early, but I mean, for what it's worth, 300 higher and about 1450, 1460 stocks lower. That's the market breadth.
Okay, let's see if the buyers come in at some point in time. Right now, we're dealing with this 140-point cut. So the weakest links are actually everything. ONGC is the one that's down about 3%. A couple of tech stocks are coming off quite a bit. Remember, the Nasdaq fell more than the other indices yesterday. A lot of the chip maker stocks were down big time. So here, HCL Tech, Infosys, Wipro, Tech Mahindra, IT is leading this decline, this wave down, which is about 2.5% on individual stocks. Coal India is down 1.5%. There is Bajaj Auto, which is lower. Remember, sales were not that great for Hero and Bajaj Auto. We'll be speaking with the management of Bajaj Auto as well in just a bit. Titan's lower by about 1.5%. Tata Steel is on the back foot. BEL, which had a good recovery yesterday, is cooling off this morning, down about 1% or so. Let's see if there's anything on the upside. So some of the banks are beginning to see a little bit of a pullback. ICICI Bank, HDFC Bank, SBI. So there is buying in banks this morning, which is interesting. And a bunch of consumer stocks could be breaking into positive. Look at HUL, ITC. These are some of the early names. Even Tata Consumer. They're still down 0.25% or so. But let's see if there's any traction on the upside. But again, as always, the much bigger problem continues to be the mid-cap part of the market, which is now down 1.5%, Nigel.
Well, let's pull up a few stocks and that are gaining actually. TD Power, we were talking about small chipping in from the promoter. That's something that I observed on TD Power. The stock has seen a sharp correction from the peak. Year to date, it's still down close to around 30%. But the stock is up close to around 8%. So that could be one of the factors at play. That's one of the big movers. Ask Automotive, remember they had announced that they signed a technical assistance and license agreement with Kushu Yanagawa Saiki. So because of that, that stock as well is up close to around 4.5%. So both those two big movers in initial trade. What's losing out? IGI, second day running, the stock is down close to around 10%. Yesterday, remember, the stock was at lower circuit. And, there were pending sell orders as well. So it appears some of those are getting executed in today's trading session. What's outperforming actually in the first few minutes of trade is the Nifty Bank. And that's giving signs that, if we need to fight back, that'll have to perform. Remember, yesterday it was an underperformer. Nifty Bank is almost into the green. It's down less than a 0.1%. So keep an eye out on that particular name. Otherwise, high beta is getting knocked back. Vedanta is pulling back 2.5%. NMDC is down close to around 2.5%. Coffee Day, not a stock we track very often, but yesterday as well, the stock was up. It's come off, I think, from the recent peak. Today as well, that one is moving up more than 10% or thereabouts. Not too bad, guys. 150 points down. I think that's par for the course. And 300 stocks advancing. That number needs to get better, though. Nifty Bank putting in a bit of a fight.
Down again, 21,975 is where we are at right now. Just one name, Tata Investment Corporation is up 5% against. It's got some volumes on it as well, about 6,200 rupees on that one. It's like a, it's like a fund basically for the like a mutual fund basically, a holding company with lots of stocks in it, blue chip names, well managed, and they invest Tata's money. Well, Blue Jet is up about 2.25%. MPS, it's got some large individual investors there, 6% higher on MPS, and a few others coming up. GHCL is up about 3%, and far and few in between. Schaeffler is up about 4%. But again, volumes quickly drying up below a certain threshold, below the first 3-4 odd, below the first 6-7 names or so.
Nifty Bank in the green.
Okay, Nifty Bank will come up. Let's put that up.
Yeah,
and that is coming back up a little bit. right now. So yeah, 10 points or so.
Just wanted to add one more stock. Arvind is seeing a major slash this morning, 9% down on Arvind. Volumes are already beginning to pick up. Now, perhaps this also has to do with the fact that some of these companies are also exporters on the textile side. I don't have the exact numbers in terms of Arvind's export business, but maybe that could be adding to the sentiment downtick. It's down about 9.5%. And IGI, AB Real Estate, by the way, which yesterday was rallying as we went into close. Again, is a slam dunk on this one, 9%. IGI is the interesting one. We had such a detailed conversation with the management yesterday. They kept maintaining that margins will not be impacted with the lab-grown diamonds, but I think the market's not quite convinced.
20% gone, and of course, it's now, I think, maybe around the issue price, below the issue price, I have to check, but it's a recent listing, essentially. So 330 or so is where we're at. Nilesh Shah is now with us, Managing Director at Kotak Mahindra Asset Management Company. He's our market master of the day. Nilesh bhai, good morning. Good to have you with us here, as always. Prashant this side. Ab kya, Nilesh bhai, is the question. And the other question is, are we there yet in terms of having paid the price for the excesses, etc.? And let's just divide this question in two parts. For the Nifty, which just purely on a PE multiple basis seems to have fallen to averages, and then mid and small caps. Go on, Nilesh bhai.
So Prashant bhai, as of today, it looks like FPIs are aggressively selling. On Friday, net of passive funds buying of about 8,000 crore. The gross sell number was about 20,000 crore. Never stand in front of a running train. If they are selling aggressively, undoubtedly buyers will continue to buy at lower and lower prices. And as long as their selling continues, we think market's unlikely to settle. Buyers will continue to buy at a lower and lower prices. In terms of valuation, now Nifty is trading little below its historical average valuation. This is a fair value market. The excesses of the past has been corrected. And now this is probably time for long-term investors to start accumulating. But keeping in mind, don't stand in front of a running train. In the small and mid caps, again, there is a divergence. Last quarter, mid-caps earnings growth was in line with expectation at more than 20%. Small caps degrew by similar amount. And again, it was little below expectation. So within small and mid-cap, go for quality, go for reasonable valuation. But do remember that right now, the mood of FPI is on the selling side. It is your opportunity to accumulate, not to buy everything today.
Got that. So let's just spend 2 minutes on this FPI bit, right, Nilesh bhai? So as you said, aggressive sellers still, and buyers will come in, but at lower and lower levels, right? And there's only limited amount of cash for people who are doing it themselves, who've got systematic investment plans. That's, of course, getting deployed at lower levels, and over the long run, hopefully that will play out. But just your feedback, because you interact with a lot of people in the ecosystem. What is behind this FII selling? And recently, one has picked up another line of argument that, and just a clamor for the government perhaps to look at taxation and things like that, or capital gains tax, and how maybe the hike was a mistake, comparison with other countries. I'm sure you would have picked up on all those things. Just wanted your thoughts there.
So one, trying to figure out FPI is like five blind men trying to identify elephant, because there is no one homogeneous set of foreign portfolio investors. The university endowment funds and sovereign wealth funds have been buyer in our market. The long only, the passive, the US-based FPIs, some of the pension and insurance companies have been sellers. So within FPI, not everyone is seller, not everyone is buyer. Now, some of the reasons why FPIs have turned sellers, one, Indian market had expectations built in, and the September GDP growth number, December GDP growth number, as well as quarterly earnings of September 24 and December 24 quarter came below expectation. It couldn't justify those valuations. On top of it, America First, Make America Great Again, resulted into American vacuum cleaner starting, which is collecting money from all the emerging markets. Every emerging market is witnessing outflow, and China hasn't published numbers since October 24, So we don't know whether they are receiving inflows or outflows. But if someone is not publishing number, your guess is likely to be as good as mine. Number 3, our rupee also was overvalued. That provided good exit to the FPIs. If I have to sum up, maybe there was a trade where rupee was likely to come down. Indian market was likely to come down. American market was likely to go up. There was a trade waiting to be taken and FPIs took it. A large part of that is now behind us. But right now, the momentum for FPI is on the selling side. But do remember, they are doing quit emerging market and ghar wapsi to America. And not every FPI is seller. If we look at the data of December 24 quarter, sovereign wealth funds and university endowment funds have been buyers. Yesterday, I was on a panel with Samir Arora, where he said that being an FPI, they have received net inflows for December as well as January month.
That's good to hear.
Just on the other point, second point, do you think this clamor to cut capital gains tax, right? We're all in the market. We all want higher. Everybody wants higher prices. But I mean, the government has got to look at their own thing. Where do you come in this debate? That there is one point of view. As markets correct, everybody becomes more introspective. That maybe this was a self goal. Capital gains tax should not have been touched, etc., etc. Just wanted your thoughts there.
So one, there should be parity. गुजराती में कहावत है घरना छोकरा घंटी चाटे ने उपाध्याय ने आटो. Our own kids at home are starving and then we welcome visitors. We should not be doing it. Investor is investor, whether it's domestic or global. We should treat them equally. Second thing, just reducing taxes does not guarantee return. What if tomorrow FPIs demand guaranteed return? Will we succumb to it? I don't think so. We should be focused on creating earnings growth and governance. We have delivered better return than all the emerging markets put together. We have delivered better return than China, Brazil, Russia, South Africa. Yes, last 7 months have been bad, but people have made money over here. And on that money, they are paying taxes. So it's not an easy answer. People who are demanding lower taxes for FPIs are probably also demanding stability in taxation policies. Once they know that there is X amount of rate to be paid, they want that to remain constant for a long period of time. So there's no easy answer, but my recommendation will be treat all investors alike, whether it's foreigner or whether it's local.
Okay, that's a very interesting aspect, and Nilesh, and brave of you to say that. Usually one would sort of jump to say that yes, cut capital gains tax, but that's not what you're saying, Kevin. I get the drift that tax policy cannot move with the swings of the market. Then we'll have to change taxes maybe every 6 months or every year, but there has to be predictability. Take that point, Nilesh. So now come in on the extent of money that you folks have been getting and then putting in the market, and thank God for that, right? Even yesterday, there was net buying of 9,000 crores from domestic institutions. We had Ramdev Agarwal on the channel yesterday, and I think he picked up some inputs saying maybe February the flows would slow down a little bit as eventually people kind of get hit in terms of sentiment. But what's your sense? And with this kind of deployment, because the net deployment on a daily basis has been really huge, with this kind of deployment, what is the net cash level industry-wide when we're talking about Indian mutual funds? And what is the flow situation right now?
So one should be, will flow start slowing down a little bit? Answer is yes. There are experienced investors and there are inexperienced investors. In March 20, when markets corrected very, very sharply, our SIP returns had become negative for 3 years. That did deter some investors and they stopped their SIPs. It also excited some investors and they topped up their SIP. Majority people were buyers during dark days of March 20 when markets were falling like a stone. And today they are rejoicing. Despite this correction, they are sitting on healthy double-digit return. So my feeling is that the experienced money will use this correction as an opportunity to buy, albeit in a calibrated manner, not in an aggressive manner. There will be undoubtedly some inexperienced money, mainly coming on direct platform, looking at last 6 months' performance. when they see negative return, they are likely to stop their flows or redeem money. My recommendation has always been that you have to follow your asset allocation model. And like for your physical health, you consult a doctor and don't go to the chemist directly. Same way for your financial health, you need to consult your advisor or mutual fund distributor. Don't invest looking at last 6 months' performance. Any direct plan on a platform, that's not going to give you financial freedom.
No, fair enough. But just the point on, so what you're saying that has been at a net level, there's been some slowdown in February. And what would the industry-wide cash position be like? I mean, there were some funds that were running as much as 18-20% cash. I'm guessing a lot of that has been deployed in this brutal February sell-off. Any estimates of overall how much firepower are you folks still sitting on?
So in the month of January, the average cash balance, and I'm just rounding off number, was about 5%. That's roughly about 1,75,000 crore. The asset allocation fund and balance advantage fund, which have ability to take higher equity as market becomes cheap or valuation-wise attractive, that's roughly about 1 lakh crore. So there is about 2,75,000 crore worth of potential firepower within domestic mutual fund industry. Obviously, it does not take into account SIP flows and lump sum flows, which can continue to come.
All right. Hi, Nilesh. Good morning and good to see you, Ben. Nilesh, first of all, you need to compliment you. I recall more than a year or so ago, you all stopped taking inflows, SIP inflows in small caps, and that worked well. My question to you is, do you think that, small caps now, they've seen a fair bit of correction? Will you all be revisiting that? So if you could give us a brief idea on that. And also, we've got a new SEBI chief, and I believe that there is feedback that, is being taken from various market participants. What would your top expectations be to the new SEBI chief?
So one, SEBI has always an open door policy, and I'm sure under new SEBI chief, the same will continue. Undoubtedly, they gather inputs from all the investors, not just domestic, but also global. Very recently at Kotak Institutional Equity Conference, we had brought certain global investors to India. And SEBI was very kind enough to meet them in their offices. When we tell these investors that we'll take you to our regulator, they are surprised because that doesn't often happen in their market. And the transparency with which our regulators interact with them, the transparency with which their questions and queries are answered, and some of the myths in their mind which are removed are truly spectacular. There's a lot of misconception about registration process in FPI. But when they look at the data, interact with SEBI, and the willingness which SEBI officials are providing to process their application, it does leave very, very good impression with the investors. I'm sure under new SEBI chief, this trend will continue. We'll continue to give our inputs for the development of the market.
Okay. Nilesh, to round things off, and you've seen so many of these cycles, and you've seen bigger crises, including the global financial crisis, right? If I were to ask you, what are the signs? One sign would be FPI buying returns. That's one clear sign. But through the years, in the last 30, 40 years of your stock market career, what are the indicators or signs that you look for and that clearly tell you that, this is the bottom is almost here?
So, Surbhi, I'll answer this in a lighter vein first. When I go to party and no one recognizes me, no one comes nearer to me, everyone runs away from me, I know that is the bottom of the market. Now, no one is interested in stock market. That's the time to go and buy. On a serious note, as you very correctly mentioned, FPI stopping.
So right now, what happens when you go to parties? Are half the people coming to you, or is the whole crowd still coming to you? Where are we on the party circuit? If there are still parties happening,
you have still invited me on CNBC, so my guess is that party is, just beginning. It's not ending.
Okay, but yeah, you were saying on a serious note, yeah.
FPI stopping their aggressive selling or turning buying will be one opportunity. The second could be the valuation. Finally, at the end of the day, stocks are slave of earning power. Value is what you get and price is what you pay. So if the valuation becomes cheap, let's say 14 times forward, 15 times forward, then certainly I believe markets will bottom out. The third could be geopolitical side. as of today, we are in a situation where America is putting tariff, their markets are going down, and everyone else's market going down. It's a lose-lose trade rather than win-win trade. If there is reversal in those geopolitical scenario, where from lose-lose we go towards win-win kind of situation, again, market will bottom out. Again, my limited point is that there's no way we can predict where the markets will bottom out. All we know, when the markets are cheap, we should be a buyer. When markets are expensive, we should be a seller. That is the dharma of asset allocation.
निवेश भाई ये बड़ा टफ टेस्ट दिया है आपने. जब आप कहीं पार्टी में जाएंगे लोग पहचानेंगे नहीं, ये बहुत मुश्किल है. तो मतलब आई थिंक बहुत रुकना पड़ेगा फिर भी. Thank you very much for that. Really appreciate your time and good speaking with you there as far as markets are concerned. 100 points lower, so there is a bit of a recovery. That 22,000 is back on the board, but it's still 100 points lower. But the important thing is, and I was saying earlier as well, there was no volume on the downside yesterday. Look at what has happened to market breadth. Market breadth has now converged almost 1:1. It was almost 3:1, 4:1 about 5-10 minutes back. And now we got about 1150 stocks which are higher and about 1270 stocks which are lower. There you go. It's almost now equal in that sense. And lots of those stocks we were talking about, Narayana was down 5-6%, is down 1%. Many of those stocks have recovered in the intervening last 10-15 minutes or so. And a lot of stocks coming up. I mean, it was all very small on the upside, but you got 3, 4, 5%, at least 10 names with decent sized volumes now, which we'll address in just a bit, which have got volumes and which have got decent price gains as well. So broader market looking much better from what the start really showed us. Guys.
Okay, all right. Well, more mature reaction is what you've seen in our markets. I think a couple of factors that played out. One is that we had already corrected, crude oil prices lower as well, a bit of a tailwind. So it's actually a pretty good looking screen, going by what we saw in the global backdrop. But let's focus on a couple of other stocks then. Bajaj Auto, that's the management next on our radar. Remember, the stock is trading closer to around a 52-week low. We have Mr. Rakesh Sharma, the executive director at Bajaj Auto, who joins us on the show. Hi, Mr. Sharma. Good morning, and thanks a lot for joining in. Well, let's focus on the domestic part of the business first. Are we on track to achieve the industry growth of around 6 to around 8% in Q4? You had briefly talked about earlier. In the first 2 months of the quarter, I think the growth is a little more than 4%. So your take on that?
Good morning. Yes, I think despite the turbulence, the little speed breaker we have hit in February, the industry does seem to should close the financial year with a 6 to 8% kind of, there's only one more month left now, which is this month. But it should come in at 6 to 8%, which is what we had said actually even at the start of the financial year. But having said that, the year has been characterized, and I think this is a sign of our times, that there have been wild swings in growth rates from quarter to quarter. So, like the first quarter was double-digit growth, I think early teens, and then Q2 sank to 1 or 2% growth for the industry. Then Q3 again went to 11-12% growth for the industry, in which October played a very important role. And Q4 expectedly was seeming to be lower even at the outset. And therefore, it's just the nature of the way the business is flowing now that it is very difficult to extrapolate from any 1 month, and it's better to take a long shot. And that long shot view suggests that the industry is at about 6% growth fundamentally.
Okay, all right. So you're sticking to that earlier guidance. Could you tell us about your market share in the 125cc segment? We believe that there is some competition out there as well. So if you could give us what is the updated market share according to the numbers that you have?
So there is competition in all the segments, and yes, but the 125cc plus segment, which is 125 upwards, not just 125, that is the area of our focus. And our market share has been hovering in the region of 21 to 23% now for the last, I would say, 4 or 5 months. And why I give this band always is because, in the end, it's a bit of a derived market share. We tend to look at retail market share, but what is published is overall. So based on historical trends, we derive competitive numbers, and that suggests that we are operating in the zone of 21 to 23%, which is a number 2 spot, a few percentage points behind, still behind the leader in that segment.
Okay, got it. Mr. Sharma, morning, sir. Just to go back to that point of growth, and you're saying industry-wide, I think 6% is a number that we should work with. I mean, somewhere this is getting a little confusing because you have the big stimulus coming in from the government in the form of the income tax cut and other events like in the northern part of the country, like this Mahakumbh. But despite a lot of these positives, the numbers have been month on month, the numbers have been, they've been dropping off. They've been anemic. An analyst that we were speaking to yesterday was telling us that the lack of adequate financing perhaps is now beginning to hurt. Is that the sense that you're also picking up? Why is it that the numbers are not firing as well as they were till the first half of this year?
Yeah, your observation is very right, because if we look at it very simplistically, it is difficult to understand the sudden downturn which almost every segment has faced. Whether you look at ICE scooters, ICE motorcycles, electric vehicles, they're all negative single digit, So February has been a little bit of a surprising point. But that's why I prefaced my comments about, the nature of growth. What we are finding since the last 2-3 years, that it telescopes within a few weeks, and then the peaks and troughs are very, very sharp. Fundamentals wise, I, agree with you that the road network is expanding. There has been an overall positive budget. The things like GST cut immediately impact the pocket, but things like income tax cuts are not easily apparent, and the net is much smaller. They affect a much smaller number of people. On your comment on financing, I won't entirely agree from at least the ground reports which we are getting that financiers who have been prudent from the beginning are continuing with the same policy. So we have not seen a pulling back. But we have, yes, noticed with some financiers that they've pulled back. But that too, I feel in certain pockets. What has happened is, and there I think SEBI also made a very correct observation, there are a lot of being small loans and which have been deployed in the stock market is what the speculation is. And then there is this wealth effect which takes place when the markets are down. So
I was coming exactly.
But I won't say that it is an all-pervasive thing. It is there in certain urban pockets. But fundamentally, I feel for the industry, it is the fundamental drivers are intact, and it is the consumer behavior which gets into a consumption cycle when it believes it is the best thing to get into.
So financing, sir, is not a concern, right? I'm just clarifying that to place it on the table for our understanding. That fundamentally, there's no, curb in financing that's leading to this. It's other factors, sentiment, etc., like you're describing, right?
Absolutely. We have a 100% captive finance company, and I can tell you that between October and now, nothing has really changed in terms of changing the risk algorithm and stuff like that. I mean, we have to exercise prudence at all times, and that's being done.
Right. Mr. Sharma, good morning. You took the words out of my mouth. I was coming to that. I've been asking real estate companies and others as well, four-wheeler companies, whether this is a powerful thing, right? You feel poorer as you see your portfolio every day mark to market, and it's worth lesser than it was yesterday and the day before yesterday and the day before that. And it's all behavior at the end of the day, consumer behavior. How much of that is responsible for, and do you think it's yet to play out and it'll have this lingering impact if markets stay like this for some time? And what part of the portfolio, the premium end?
No, your observation is right. I agree with you. At the end of the day, there is so much of sentiment involved, particularly when you come to products which have got a discretionary purchase, like holidays or motorcycles for that matter. When there are headwinds, people tend to postpone these purchases or downtrade to some extent. So I would agree with you. My only limited point is, that this wealth effect aspect driven from the stock market is not an all-pervasive thing. We have seen rural incomes go. So we made a comment about the Mahakumbh, etc. We feel that the Mahakumbh factor is going to play out. I mean, it's just concluded, right? These factors will play out. And I think, I personally feel that in the oncoming mini season, which begins by end of March and continues this time right through April, May, June in the north, which is the marriage season, you will see a reversal of trend, because that is again the nature of the beast. People start to hold back. And let me tell you, a lot of this consumer behavior is being shaped by some of the mega companies in e-commerce, these Black Friday type of sales, etc. There is slowly a psyche is evolving, which controls the discretionary purchase and times it with the best periods in the year. We are seeing that phenomena play out. And that's why I'm saying that this minus in February is not alarming as yet. Yeah, if it repeats over 2 or 3 months, then one would sit up. But otherwise, I would expect this negative to reverse into a positive growth, perhaps in the next quarter, beginning end of March to entire Q1. That is what my expectation would be.
Okay, and so final question on this whole tariff business. While a lot of the export markets that you operated, there's no issues over there, whether it's Latin America or Africa. But as you're watching this from the sidelines, all this play out, do you see either challenges or maybe even opportunities because of the cross flow with, counter tariffs from one country to the other? Basically, this whole US tariff business, does it impact you in any way, positively or negatively, either for end products or even for the supply chains?
Well, not tariffs in particular, because large parts of our business are in the emerging markets, which are not in the radar screen and in the crossfire. But the consequent impact of all this discussion, the seeming reversal of globalization, is definitely causing, again, some instability in emerging market currencies. And that leads to, that devaluation leads to inflation in the local markets. Of course, in another way, the devaluation of the rupee is helpful for our bottom line. But on the other side of the coin, our retail markets experience inflation, and that sort of impacts demand. But on the positive side of all this, I think I see an opportunity for a China plus one kind of a story emerging for India, where there are a lot of companies now wanting to source, wanting to spread the base, certainly into countries, capable countries like India. I would say we missed the first bus, where people like Bangladesh, even Bangladesh and Vietnam harness the wind. But I think we've got handed a second opportunity for this China plus one kind of a move. And that could augur well for our manufacturing.
All right, Mr. Sharma, we'll wrap up on that very optimistic note, and I hope it does play out for the industry. Thank you very much for explaining all of that and sharing those insights with our viewers here on CNBC-TV18. Till the next time then. Well, 70 points lower on the Nifty. There is a recovery afoot. And forget the Nifty. Look at the broader market. It's completely turned around from 4:1 declines to advances. It's now 2:1 advances to decline. The NSE market breadth, the advanced decline will come up, and that is essentially the signs of a recovering kind of market. 1,600 up, 800 lower, 800, almost 900 lower. And we have to mention these stocks. I know we have another management waiting, but look at just a few of these. KRN is the top volume-led gainer right now. Stocks at about 928. KRN Energy. You've got Schaeffler, which is up 4%. It's got large volumes. TD Power Systems is up 8%, 329. There is Garden Reach, which is up 6%. Stocks at about 1287. Zentech is up 5.5%. These were all stocks not in the mix in the morning when we looked at least for the first 15-20 minutes or so. Zentech, that is, 1,097 on Zentech. Blue Jet is up 3%. Let's have Blue Jet up, please. Praj Industries is up about 6.5%. Jyoti CNC is up 10.5%, 11%. Stocks at about 855 at this stage. Okay, there you go. That's Blue Jet, Praj, Jyoti CNC. Look at something like a SW Solar, which is surging. It was flat 5 minutes back. It's up 5.5%. SW Solar. Look at GHCL, which is up 7%. Gravita is up 5%. Taj GVK is up 4%. Newland Laboratories is up 5.5%. Suddenly, there's like a burst of activity in mid caps and small caps, all in the last 7-10 minutes or so, less than 10 minutes actually, because this is all fairly new, and there's more, but you get the broad gist. So broader markets, very solid recovery coming through. We take a break. We'll have the management of Jupiter Wagons joining us, Jupiter Group joining us to talk about the business and order book picture. Stay tuned.
Welcome back. Well, let's talk about Jupiter Wagons. Their subsidiaries have been in the news lately. Jupiter Electric Mobility will launch its first commercial EV. Another subsidiary has received a 255 crore order for wheel sets, and the company also has a big capacity expansion plan. To talk about all of this development, we're joined by Mr. Vivek Loya, the managing director at the company. Hi, Vivek. Good morning, and thanks a lot for joining in. Well, let's focus on the first point. Jupiter Wagons will be launching the first commercial EV, which is Jupiter Electric Mobility TEZ in Indore. Tell us about this development, the rationale, revenue potential, and how do you see things pan out?
Yeah, so good morning and thank you for having me on the channel. So this has been in the works, the launch of the car has been in the works for the last 3 years. The whole idea was that we were already working with the major OEMs, mainly Tata Motors and Volvo. We were their biggest manufacturers for load bodies and chassis. So the entire idea was that how do we complement the entire infrastructure. So that was the genesis of the launch of our ELCV segment. So finally, yesterday we have launched the vehicle. It is a 1-ton vehicle with the maximum range right now in its class. On road, it is giving a range of about 190 kilometers, and it's got a fast charge where you can charge the vehicle in 1 hour. The payload capacity is also the highest in the segment. We have got a very strong positive feedback from the market. The vehicle will start rolling out to our dealers in this month itself. And towards the end of the year, we plan to also launch a 2-ton as well as the 3-ton payload variant. So this basically covers our entire last mile and mid-mile ELCV segment. And that is our key focus.
All right, Vivek, just to reconfirm, in this particular vertical, you have around 75% of the company, right? Of this electric mobility. Got it. And going by all the launches that you said, what kind of revenue potential can you throw up? FY26, FY27, potential margins as well out there, and your peak operational capacity?
So right now for the vehicle business, our capacity is at about 8,000 vehicles. And FY26, definitely, again, to give specific numbers, since we've just entered the segment, to give definite numbers, it's very difficult. Yeah, if you look at the segment, currently the ELCV segment in India, typically about anything between 400 to 500,000 vehicles are sold in this segment. And by all estimates, in the next 2-3 years, you're looking at least a 25% conversion from ICE engine to electric engine, because there is a distinct economic advantage of using an electric vehicle. And especially in the metro markets, you're seeing that the charging infra is developing rapidly. So that is giving a huge boost to the segment. So we expect that in the next 2-3 years, this will be close to 100,000 plus vehicle market. And idea is to be ready with the entire bouquet so that we can aggressively tap this segment. Besides this, again, another key in terms of the subsidiary, the key focus for us is our wheel business, where we are undergoing a massive capacity expansion. We'll be investing close to about 2,500 crores in the next 2 years. We are setting, besides the existing facility in Aurangabad, we are setting up a greenfield facility in Orissa, where we will take the capacity up to 100,000 wheel sets, and of which close to about 50% of the capacity will be exported to the European market, and mainly to our partners, Tata Wagonka, who are the biggest manufacturers of rolling stock currently in the European market. So they have a sizable demand for wheel sets. So this is basically going to complement their entire rolling stock business.
Let's talk about some overall targets as well. I mean, I think the original target was doubling revenues to about 600 crores. So as we're almost, about to wind down the year, in terms of top line, where do you think you'll end the year? And what is the CAGR growth that you'll target for, say, the next 1 to 2 years?
So, if you look at the wheel business specifically, 600 crores which you are talking about is the target for FY26. This year we are going to grow by close to in FY24 we did a number of about 100 crores in this business, which in this year we will take it up to 300 crores. Right now the only limitation for us is the capacity. So in Aurangabad, from now 13,000 wheel sets, we are ramping it up to about 20,000 wheel sets. In the next 4 to 5 months, that capacity will be online. So that will, the 600 crore revenue target, basically that will help catapult us to that target. And once the Orissa capacity comes in, you're looking at numbers of close to anything between 2,500 crores to 3,000 crores of revenue just from the wheel business itself.
And which year would that be, when Odisha is fully operational, commercialized?
No, it'll 26 end is when the axle line is going to start, and 27 is when it'll be completely commercialized.
Okay. All right. Okay, we will leave it on that note. Thank you very much for joining in and giving us a sense on the business. That's the management at Jupiter Wagons. Back to the screen now, and what a brave, pullback by the bulls, you'd have to say, from a decline of 2% on the Midcap index. Now it's a recovery of 0.5%. Beautiful exchange on the advanced decline ratio as well. It's a phenomenal screen to be looking at. So good to get Mitesh in. Mitesh, what's the sense? What are the trades now?
So I think should be the first signs of a reversal, at least from the banking names. Though I think it's still to be confirmed. I would want to see the bank Nifty get past 48,350, 400 zones, and then we can look at 48,600, possibly 48,900 to about 49,000. I think if that plays out, then I think we'll have a good bounce back, and that will weigh in on the Nifty as well. I think what was the fear in the morning that the bank Nifty could break down. It hasn't done that because we didn't sustain below 48,000, and now I think we are trying to give a reversal on the hourly charts, and my figure is about 48,400. So above that, I would want to take some long positions on the bank Nifty with a 120, 140 point kind of a stop loss, and play out for 400, 500 point kinds of rally from there. Having said that, on the stock side, Bandhan Bank is something which has caught my eye. It did well after the morning decline and is giving a reversal. So buy here with a stop at 140. The first target on the upside should be around 147, though I suspect we are looking at about 153, 154 on the upside. And the other stock is Indigo, which it actually didn't decline also much. This has been clearly showing outperformance, and today the intraday charts are also positive. So Indigo is a buy with a stop below 44.80 for targets of 46.20.
Okay, all right, Mitesh, thanks a lot for that. In fact, Interglobe is one of the stocks on the radar because crude oil prices have cooled off, which could have a bearing on the ATF prices as well. So that's one big stock that's recovered from the day's low, and the OMCs as well. Falling crude is a positive for them. It could help them in terms of their EBITDA numbers as well. So you pull up HPCL, BPCL and IOC. All of them from the low point of the day have seen a big recovery. Not ONGC, but the OMCs is what we're talking about because they gain when crude oil prices move down and all of them have seen a big recovery from the low point of the day.
All right. No, I mean, I think it's a solid bounce coming through on the broader markets, and market breadth is improving even more as things stand right now. Let's talk about IT services as a space. Now, Sandeep Agarwal is with us, fund manager at Sowilo Investment Managers. Sandeep, good morning. Good to have you here. Prashant on this side. Now, IT, 2 weeks back, it was looking like it was not correcting. It was down about 8% from the highs. Last 2 weeks changed all of that. It lost another 10%. So we're down about 18% from the highs for the IT index itself. The other question more recently, of course, is if the US market starts to come off and growth indicators, etc., are moderating, what will it mean for the market as such? Specifically, what will it mean for the IT services sector? So just start with that basic point. We've had very strong US economy and markets for a few years. And for the first time, we are starting to hear that maybe things are going to go in the other direction for a while. Maybe temporary, we don't know. How does it affect IT services companies from here, where they are already? Sandeep. You'll have to unmute yourself, Sandeep.
Yeah, hi, good morning, and thanks for having me on the show. So, Prashant, if you recollect our earlier conversation just 18-20 months back, when there was gloom and doom in the industry, we were extremely constructive and we were very positive. Last 5-6 months back, if you see all my interactions, I have been saying that, all the positives are baked in, but any kind of negative which can come, and if it at all comes, then we will be in a difficult spot. Now, Indian IT has a more than 95% market share globally in the outsourcing part, if you exclude the BPO piece. So we are very strongly positioned when it comes to execution at a reasonable price. But remember, when US economy was doing well, we were hurt very badly because of the disruption which was happening on the AI side. Because whenever disruption happens, the biggest task which Indian IT companies have, they have to, train their whole workforce into that new technology. And by the time when we are 2/3 in that journey of training, we are now seeing early signs of some weakness in the US economy. So, because Indian IT is priced to perfection and one of the cash flowing sector, no one leaves these stocks easily. And there are gaps in 2 or 3 years period of 2-3 months when you get them dirt cheap. And that gap, I think 18-20 months back was there. Now, I think, large part of correction has happened, but I still believe there is some more correction which will happen. The primary reason of saying this is that, no negative news from Trump at least has come yet on the sector. And Trump being Trump, you cannot take him for granted that, he won't do anything in such a big exporting sector. You remember 2014-15, all these localization things came and he enforced that we have more than 50% local employees and all, and that wiped out the margins of the Indian IT companies because local employees are hard to get and very expensive. So nothing can change that. Although, I can tell you that there is no one who can execute at this price in the US, and ultimately the US consumer will suffer very badly if any harsh step is taken on Indian IT. But having said so, politics being politics, you cannot take a call on either side.
You're talking about making it more expensive, sort of tougher to hire Indian workers. I mean, on that side, right? On HR side. You're not talking about a tax on services or anything in that sense.
I don't think it will be tax or services, but it will be more like, he may put in some more condition that you have to hire more local employees. And that becomes very difficult because it is in that market, employees are not available. So if you have to hire more, those few number of employees are chased by more number of employees. So the salaries and the outflows start going up, putting a dent on the margin. So the cost of doing business can go up. That is all I'm trying to say.
Okay. All right. Sandeep, good morning and thanks a lot for joining in. Well, FY26 growth forecasts are mid to high single-digit growth. The recovery, though, has been gradual. Do you think we get back to, say, double-digit growth from FY27 onwards?
I think so, because, in FY26, what will happen, all your training of AI workforce will be broadly over. So after that, we will get some benefits. So low double-digit growth or high single-digit growth is something which FY27 can obviously deliver. But with similar margins. So in that case, what multiple you assign is a very important question. I think the large names like TCS, Techem, and HCL, Infosys, Wipro, they are broadly corrected and the time correction is also done. So I think some money could be there. But some of the names still are very expensive in the mid-cap space where, we have little less comfort and we believe if cost of doing business goes up, then there is some risk.
But so you're saying there's some more correction ahead, perhaps in large cap IT names. And then the basic question, Sandeep, I mean, even if someone decides to buy IT, it'll probably be for other reasons, for instance, cash, safe haven, etc. In terms of growth, can we hope to buy anything more than 5-6% growth or 4-5% growth in these companies? Next 2 years, say, will the growth numbers look the same, or do you see some improvement?
No, I think FY27 will be better than FY26 by 2 to 3% at least.
Which means how much growth in FY27?
Around 8 to 12%, depending on the size of the company, is what I see in 27, but not in 26. In 26, I am more like 6 to 8.
Okay, but that's good. 6 to 8% growth in 26, and maybe 12% in FY27. Don't remember the last time we were in double-digit growth. So then leave us with some top picks. If someone has that at least 1 year time horizon, if not longer, then what would be your top picks that you would perhaps be convinced on?
So we run a PMS. I will not give stock specific name, but I will give you a flavor. So, in the large cap, there are few stocks which are now reasonably priced at 16-17 times 1 year forward. Those are the stocks which you can start looking at. And in the mid cap, other than the ER&D space, if you are getting something at 18 to 20 times, so PEG ratio of 1.25, 1.5 is something we can start looking at. And in ER&D, you have to give obviously minimum 2 times PEG ratio, because that is a space which will do more than IT services growth for next decade. So you will have to pay a higher premium there. So we clearly see ER&D as a very good play for a longer term if we get at a right price. And within the mid cap and large cap on the IT services, we will be willing to give around 1 to 1.25 PEG ratio. And whenever stocks are coming in that range, it is an attractive level in my view.
All right, Sandeep, we'll leave it there. A shorter chat today, but very, very useful in these volatile times, and gives us a broad idea about how to think about the space. Thank you. We take a break. We're back with Manisha on the other side. Commodities in focus.
Welcome back. So the Indian equity screen is trying to recover. It's not looking as bad as the dire morning. Let's find out what's happening in commodities. Manisha's with us in the studios. It's all rock and roll, isn't it? Particularly in those Bitcoins and Solana and whatnot. But you tell us, Manisha, what's the latest?
Well, I'm looking at all of those markets right now because, you couldn't choose anything. Everything really seems to be looking at off-risk appetite in these markets. And the broader market sense really seems to be taking a hit because of that. And today is yet another day. But you rightly said it's not so sharp, not so deep, and not so bad today. But the pain just about continues as markets are looking at tariffs and then this conversation about retaliatory tariffs as well, which seems to be weighing in. I just want to put some numbers in and explain. Well, US as of now has said that they're looking at 25% tariffs on Canada and Mexico, and that 10% tariff on China will go up to 20%. But if you look at those numbers, well, US imports worth nearly $900 billion from both of these countries. And when you look at both of these countries like Mexico and Canada as well, the export numbers that go to the US are really big. So it is really going to be impacting all of these countries there. So 83% of all Mexico exports happen to US and 78% of all exports from Canada happen to US. So those are big numbers that we're talking about. And this is going to be bothering broader markets as well. Well, US is looking at higher tariffs. And I also want to talk about reciprocal tariffs because that is a statement that also has come in from the US President Trump. He says that reciprocal tariffs will take effect from 2nd of April. So we're looking at tariffs right now. Retaliatory tariffs will come in from other countries and reciprocal tariffs from US will take effect on 2nd. So this is not really ending in any time soon. We already have seen statements coming from Canada announcing retaliatory tariffs, which will come in effect from today when the market opens. The second statement comes in from China, which has rejected US tariffs, saying that they will take countermeasures as well. And we have seen that impact come into the markets. Crude, for example, this is a third straight year that we are trading in negative for the crude oil prices, down by nearly 6% for this year until now. Overnight, we saw 2% of decline, and these prices really are a 12-week lows that we're looking at. The U.S. crude prices are now just about holding $68 a barrel there. The other factor that's bothering crude really is OPEC statement saying that they will increase output in the month of April. They really seem to have written that bullet that US has been given them. Apart from that, the US and Russia conversation also perhaps could give some relief on sanctions to Russia. Russia, remember, is the third largest oil producer after US and Saudi Arabia. And we are looking at more Russian oil coming into the market. That also seems to be weighing in. Base metals should come in on your screen because we've seen a decline on that as well. On a week-on-week basis, almost every metal is trading in the negative side. The biggest declines coming in for iron ore, trading at a 6-week lows, and the steel prices trading at a 3-month lows as well. The U.S. consumer sentiment for the month of January declined for the first time in 2 years. that seems to be bothering as well. And yes, I also want to talk about crypto markets because after US signed that notification about including many of those cryptocurrencies in their strategic reserve, we saw the prices run up quite strongly, but not anymore. The last 24 hours really have been quite harsh. So 10% down on Bitcoin right now, 15% down on Ether, 20% down on Solana. And you have declines coming in for many of these cryptocurrencies to the tune of 30 to 45% as well in the last 24 hours there. But there's important data coming in as well. You have ADP employment numbers that come in on Wednesday, and then you have US non-farm payroll data that comes in on Friday. So this continues to be a very, very active week in that sense.
All right, Manisha, thank you very much for that. I'm wondering, Surbhi and Manisha, what are tariffs when you impose tariffs and there are the other country imposes tariffs? They're called reciprocal tariffs.
Or retaliatory. You can choose whichever word
and
sounds
then
better.
If the first country imposes tariffs in response to the retaliatory tariffs, what are those called?
Dual retaliatory. I don't know. I'll think it up in the break. It's called a tariff war, to keep it simple. Global trade war.
Okay, all right. Well, Manisha, thank you very much for that. We'll take a quick commercial break here. We're going to come back, but we're going to focus on the local economy. And we'll talk about NBFCs with Jairam Sridharan of Pyramid Enterprises. He's Lata's guest on the other side. Stay tuned. Interesting chat coming up.